Bilal, just walk me through the call.
Yeah, so essentially our view is that you have twin deficits that are a structural force that should weigh down on the dollar. You have Trump, who wants a weaker dollar to help the U.S. trade position. And then on top of that, the market knows that the Fed's going to hike rates. But the market has yet to fully price in the fact that other central banks are going to start to tighten policy. And it's only a matter of time before they do that. And so all of these forces will weigh down on the dollar. And so as a result, we think the dollar will fall over the summer, if not longer, for the coming year or so.
So, Bilal, you mentioned the structural forces, and that's certainly the explanation, that and the investor flows behind the moves of last year. I think a lot of people looking at the move of the last few weeks and wondering whether rate differentials start to assert themselves on this market a little bit more. Are you saying they won't?
Well, I think over the past 3-4 weeks, they did temporarily have an impact on markets. We certainly saw correlations pick up and so on. But you have to remember the way they impacted markets was that U.S. yields went up, U.S. equities fell, credit spreads widened, and the dollar strengthened. So these are all kind of classic signs of risk aversion, position adjustment type moves. If this was really a story of the US doing really well, investors wanting to pile into the US for that reason, it wasn't evident in terms of the types of flows that we saw. So this is, in our view, it was yield-driven recently. It's more position related, though, rather than anything more dramatic.